when I was preparing for my running days back then, I started off with a mode where I was running non-stop. Like, let's say if I was training for 10 kilometers, my run would start a bit slow, but then I would hit after the first kilometer, I would hit my comfortable running pace and would maintain that throughout until the end. And that did not scale well. That did not scale well for me for say a 21-kilometer run.
Correct.
And then eventually I also landed up on this run walk approach, and I figured out even over there, like my rhythm would vary depending on, let's say, the time of the year or how much preparation I gave time to. So I think that is the investment rhythm, I would say, or the running rhythm. Now,
Correct.
similarly, you may have an investment rhythm as well. Now, for running, it's easy to determine for yourself because how you're feeling, you can do that pulse check. You can say, okay, I'm running too fast, my heart rate's increasing more than I'd like to, and then you can make the adjustment. How does one think of an investment rhythm like that?
Yeah. See, again, you hit the right point because when we are running the marathon, normally, people who are not accustomed to it or who have started running, they think it's just about running the fastest pace possible, right? But once you have run for some time, you realize that it's more about maintaining, your heart rate. It's more about focusing on your breathing, and then whatever pace you're comfortable with, that is the pace at which you run, so that you can sustain it, right? So it's the same thing in investing. So the way I think about it is, first of all, you know, you need some money or some savings to invest, right? So that's a starting point where when we get some income, typically we think income minus our expenses is equal to our savings, which we can invest, right? But the right way to think about it is income minus investments is equal to your expenses. So what I mean is, if my monthly income is 100 rupees, then right at the outset, I save 10, 15, 20 rupees and only spend the remaining 80 rupees, right? And out of that 10, 15, 20 rupees I have saved, then I decide how much I should invest. So I always have some savings or some money that I can invest every month. That is step number one, right? Step number two is what we call the SIP or systematic investment plan, right? Now, what it means is that every month out of your savings, you need to invest money. It might either be in mutual funds, it might be in direct stocks, or in any other asset class that you're comfortable with based on your asset allocation strategy. But you need to invest every month, right? And that is called the systematic investment plan. The third thing is, like I said, depending on the level of the market, deciding your asset allocation. So you should always be clear in which asset class you should be overweight or underweight, right? And like I mentioned, the simplest way to do it is to think about equities, fixed income, and commodities, right? And for people like you and me who might be doing their jobs or who might be running a business, it becomes very difficult to keep track of everything that's going on in the market. So mutual funds become the easiest route, right? And you have different types. You have equity mutual funds, you have fixed income mutual funds, you have hybrid mutual funds. Now you have index funds and ETFs, right? So you can invest in them, get exposure to different asset classes, and keep on rebalancing your exposure to the asset classes, right? So this is how you build up your investment rhythm in terms of, if every month you save some money out of which you can invest some portion. Second, you follow your systematic investment plan so that every month you're making some investment. And third, you're following your asset allocation and rebalancing strategy. This is the same way, like we mentioned, like you track your heart rate, you focus on your breathing, and then you run at a sustainable pace while running.